funds have emerged as the perfect go-to investment avenue for most of the investors. Indian mutual fund AUM, which is asset under management, has grown exponentially from 8 trillion in the year 2013 to 39.34 trillion, which is 39.34 lakh crore as of August 31st, 2022. All this implies that post all the challenges that we have faced, be it in the form of demonetization or even pandemic, there has been a real surge in people opting to invest in mutual funds as a veritable source of wealth creation. But do you know what? Do you know that there are certain important factors that you need to consider even before you are investing in mutual funds? Yes, although mutual funds gives you a steady return, but there are risk factors that you have to undertake, and there are certain factors, other factors that you need to consider even before you invest in mutual fund. So let's get started and understand in this video what are the things, what are the factors that you need to keep in mind before you invest in mutual fund. And especially if you're a first time investor, then do watch this video till the end, because you will get an idea what are the mistakes you can avoid in the future. Hello guys, I'm Namita Pandey and welcome to yet another video of Freedom. And if you have not yet subscribed to our channel yet, so first subscribe to the channel. So the first factor is invest in right mutual fund. So what does that mean? Well, you must invest in the mutual fund depending on two factors, which is the financial goal as well as the risk appetite. Now for an instance, you may be an conservative investor who seeks or who wants a regular income, as well as you want the safety of capital as everyone. Here, what you can do is you can invest in appropriate debt funds to achieve your investment objectives. Now, what are debt funds? Well, debt funds are also called as income bonds or bond funds. They invest in fixed income securities such as the corporate bonds or such as the government bonds. So, if you're investing in debt funds, you will be assured that you get a steady return over a period of time. While on the other hand, you may invest in equity funds if you want, say, capital appreciation over some time. Now, you can invest in equity mutual funds if you are an aggressive investor and the investment matches your risk appetite, which basically means if you are ready to take the risk with your investment and the money you have invested in, then you can choose or you can go for equity mutual funds, which gives you higher return, which also comes with high risk as well. So this is the first factor you need to keep in mind. Moving on to the second factor is you need to invest based on the time horizon. Yes, you can invest in the mutual fund based on what is your investment horizon. Say for example, I am ready to invest in mutual funds for the next 10 years, for the next 20 years. So for example, if you want to invest in equity funds for a long run, you can achieve your long-term financial goals. For example, you can invest in debt funds if in case you want to say, for example, if you want to achieve a short-term or even a mid-term financial goals. Now here your long-term goal can be, say for example, you want to buy a home in the next 10 years, you want to plan for your retirement, that could be a long-term financial goal, and for that you can invest in equity mutual funds. While on the other hand, if you want to achieve your short-term financial goal, like we mentioned, that could be, so for example, it could be buying a car, repaying all the debts you've taken, etc. So all these short financial goals if you want to achieve, for that you can invest in debt mutual funds. The third factor is direct plan gives you higher returns. Now this is yet another important factor that you need to keep in mind. Well, direct plans and regular plans are not different. The only difference comes here is with the expense ratio that you will be paying. Now what is expense ratio? Expense ratio is basically the charge or the fee that you pay to the fund manager. Now whenever you're opting for a direct plan, here remember you're not paying any kind of charges or the fees to the fund manager, and that amount you will be saving for your other investments, and with the same amount you can say buy more mutual fund units. So that is a direct plan versus the other one, which is a regular plan. Now here you are investing money through a fund manager. So here the fund manager is the expert who will be reinvesting the money you have paid them. So they will identify the right kind of companies for based on your investment objective and based on your risk appetite. So here for that work you will be paying certain charges, which we call it as an expense ratio. So whenever you are investing in mutual fund, remember you can go for direct plan when compared to the regular plan. Well, the next factor you need to keep in mind is whenever you are investing in mutual fund, look for or aim for a long-term investment plan. Now, whenever you're investing in mutual fund, do not think that you will invest say for 1 year or 2 year and redeem all the money by selling all the mutual fund units that you have purchased. It does not work that way. If you are investing in mutual funds, ideally you should stay invested for a period of say 7 to 10 years, ideally, if you are expecting a good return out of the investment that you have made. Moving on to the next factor is you won't get the same return every year. Now, normally when you hear mutual fund returns, they are annualized returns, which means every year you get a certain percent of returns by selling the mutual fund units. Now, this can give me an impression that, okay, yes, I will get the same return from the mutual funds every year. Now, suppose that the annualized return this year you might get is 8%. But let me tell you, you cannot expect the same return every year. This 8% you cannot expect every year from the same mutual fund unit or the scheme that you have invested in. For example, a mutual fund scheme might give you 10%, more than 10% of returns in the first year. Maybe second year you will get minus 2% of returns, or maybe there are times when you will not get any returns at all. So here you need to be mentally prepared whenever you are investing in mutual funds that you will get the returns as per the market performance, because you are indirectly investing in stocks. So here you need to be well prepared when it comes to returns that you're expecting. You cannot expect high returns, neither can you expect a lower returns as well. The next factor is SIP will help you to create investing discipline. Now, whenever you are investing in mutual fund, there are two modes that you can opt for. One is lump sum and the other one is SIP. Now, let me tell you, when you are opting for SIP, here the automated investing via SIPs not only help you to teach discipline, you will get discipline when it comes to investing, but they will also help you to benefit from the market volatility. Now, that's because when the market goes down, you get to buy or get to purchase more number of mutual fund units at a lower price. Now, this helps you to bring down the overall cost of investing. So this is what is called as rupee cost investing, which can help you to generate good returns over a long run. And the last one is asset allocation. Well, there is a famous saying or a famous quote which goes like, never keep your eggs in the one basket. And this is very much relevant when it comes to investing as well. Asset allocation is the process of dividing your investment across asset classes to reduce the portfolio risk that you're taking. Now, before you start investing, you need to make a very crucial decision when it comes to allocating the asset classes, allocating the money you will be investing in asset classes, such as how much percent you will be dedicating to equities, say, or debts or gold, real estate, etc. So how much percent are you willing to invest in one asset class? So here, for an instance, if you're a young investor, you're a first time investor, then here what you can do is you can diversify your portfolio with great exposure towards equity mutual funds if you're young and you can take that risk. However, you may later on shift your exposure from, say, equity mutual funds towards a debt mutual funds, as in how you near your retirement age. So now let me quickly give you some of the pointers what you need to keep in mind before investing in mutual funds. The very first one is you need to opt for a mutual fund with lower expense ratio. Now, the expense ratio, as we have already learned, is the cost of managing the mutual fund that the mutual fund manager takes or charges. The second is you need to check the taxation rules of equity, debt, as well as balanced mutual fund schemes whenever you are investing. So there are certain tax that you need to pay on them as well. The next one is you must check the portfolio of the mutual fund to determine the quality of the investment. So before investing your money in mutual fund, do a thorough research. Only then you decide to give your hard-earned or invest your hard-earned money. The next one I'll tell you, this is a kind of benefit that you get when you're investing in mutual fund, and that is you get the facility of availing a loan also against your mutual funds. And lastly, you also need to check the mutual fund's exit load. Now, what this is it is basically the fees that is charged by the AMC, which is the asset management companies, whenever you're exiting the investment that you have invested. So these were the few points that you need to keep in mind before you are investing in mutual funds. I hope this video was quite helpful to all the first time investors as well as those who have already invested, so that they can avoid these mistakes in the future and they can maximize their returns by investing in mutual fund. Also, if you're someone who wants in detail knowledge of how you can invest in mutual fund, how you can go about it, and also if you're interested to learn how you can invest in stocks or say other investment options, safe investment options, for that you can download Freedom app. You can download Freedom app from Play Store or even App Store, and also the link is provided below in the description box, wherein you can click and you can download Freedom app. So if you think this video was quite helpful, do not forget to hit on the like button, subscribe to the channel, and do let us know in the comment section below how you like the video, and also subscribe to the channel. Thank you for watching Freedom, Get Wise, Break Free.